Before we dive in, it's crucial to understand that the information presented in this video is for educational and informational purposes only. It is not intended as and should not be construed as financial, investment, or trading advice. The foreign exchange market involves substantial risk and is not suitable for every investor. Past performance is not indicative of future results. Always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Your capital is at risk. $6.6 trillion. That isn't the budget of a small country. It's not the net worth of the world's top 10 billionaires combined. That is the amount of money that changes hands on the foreign exchange market every single day. It is the largest, most liquid financial market on the planet, dwarfing the New York Stock Exchange by more than 25 times over. For decades, this ocean of capital was the exclusive playground of central banks, multinational corporations, and Wall Street titans. It felt a million miles away from Main Street, an impenetrable fortress of finance. But what if I told you the keys to that fortress are now available to almost anyone? That the same global stage where giants battle over currency values is accessible from the device you're holding in your hand right now? This is the world of online Forex trading. At its core, the concept is beautifully simple. You're speculating on the value of one currency versus another. You believe the European economy is strengthening and the euro will rise against the US dollar? You execute a trade. You analyze data suggesting the Japanese yen is about to take a dive? You execute a different trade. It's a 24-hour, 5-day-a-week market driven by global economics, politics, and sentiment. But there's a catch. You can't just call up the Federal Reserve and say, "I'd like to short the Swiss franc." You need a gateway. You need a bridge to connect your home office, your laptop, your smartphone, to this massive decentralized network. That bridge is the online Forex trading platform. And that brings us to the real multi-billion-dollar question. With literally hundreds of these platforms out there, all flooding your social media feeds with slick ads, promising tight spreads, instant execution, and powerful tools, how in the world do you choose the right one? How do you tell the difference between a top-tier, regulated, professional-grade brokerage and a poorly designed high-fee trap? Or worse, an outright scam? Let me be crystal clear. Choosing the wrong platform is not a small mistake. It's not an inconvenience. It can be the single most devastating error a new trader makes. It can be the difference between having a fair shot at navigating the markets and lighting your hard-earned money on fire before you even place your first trade. That is precisely why this series exists. We are not here to give you trading signals or tell you which currency pair to buy. We're here to give you something infinitely more valuable. A complete, unbiased, step-by-step framework for understanding, evaluating, and ultimately selecting the online Forex platform that is right for your specific goals, your risk tolerance, and your trading style. We are going to pull back the curtain. We will demystify the confusing jargon. We will cut through the marketing fluff. And we will arm you with the critical knowledge you need to make a confident, informed decision. I remember my own beginning. The sheer overwhelm was paralyzing. I'd log into one platform and it looked like the cockpit of a 747, 1,000 charts, indicators, and blinking lights I didn't understand. I'd try another and it was so simplistic, so bare bones, I wasn't sure if it was a serious tool or a video game. I made the classic mistakes. I signed up with a broker that had ridiculously high fees, hidden away in the fine print, that just chewed away at any potential progress. I used another with a clunky, unreliable mobile app that froze during a critical economic news release, costing me a significant opportunity. These are the exact costly pitfalls we are going to teach you how to see from a mile away. So here's our roadmap. Over this series, we are going to deconstruct the entire world of online brokers. We'll start with the absolute fundamentals, what a broker is, and more importantly, how they make their money, because understanding their incentives is key. From there, we'll tackle the single most important topic, regulation and security. Then we'll dive deep into the engine room, comparing different broker models, analyzing fee structures like spreads and commissions, so you know precisely what you're paying for every trade. We will scrutinize the actual trading platforms themselves, the charting software, the analytical tools, the mobile apps, and even the often overlooked quality of customer support. By the time we're done, you won't just know a few popular brand names. You will possess a powerful mental checklist, a filter that you can apply to any broker to see it for what it truly is. So let's begin at ground zero. Before we can even debate which platform is best, we have to answer a more fundamental question. What exactly is an online Forex broker? What is their functional role in this $6 trillion universe? The simplest analogy is to think of them as the ultimate financial middleman. Imagine you want to buy a very specific rare vintage car. You don't personally know anyone who owns one. So, you go to a massive specialized car auction. The auction house provides the venue, they verify the sellers, they connect you with a huge pool of potential cars, they facilitate the transaction securely, and for this service they take a small fee. An online Forex broker does the exact same thing, but for currencies. They provide the venue, the technology, and the connection. They are your regulated portal to the global currency market. Their first and most critical function is providing market access. The Forex market, unlike the stock market, isn't located in one building on Wall Street. It's a decentralized, over-the-counter market where giant banks and institutions trade with each other directly. As a retail trader, you can't just plug into this institutional network. The broker does that for you. They aggregate price quotes from multiple liquidity providers, big banks essentially, to offer you the tightest possible bid-ask spread, which is the small difference between the buying and selling price of a currency pair. Their second function is both powerful and incredibly dangerous: providing leverage. We are going to dedicate an entire future part to leverage because it is that critical to understand, but for now, here's the 30,000-foot view. Leverage lets you control a large position in the market with a much smaller amount of your own capital. For example, a leverage ratio of 50-1, which is common in the United States for major pairs, means that for every $1 you put up from your account, you can control $50 in the market. So with just $2,000 of your own money, you could control a position worth $100,000. This ability to amplify your capital can lead to substantial gains from very small price movements. However, and I cannot stress this enough, it is a double-edged sword of the sharpest kind. It amplifies losses in exactly the same way. A small market move against you can wipe out your entire account. Understanding a broker's leverage offerings and, more importantly, their risk management tools is absolutely non-negotiable. And finally, the broker provides the platform itself. This is the software, the command center where you'll spend all your time. It's the application on your computer or the app on your phone where you view live price charts, draw trend lines, apply technical indicators, and most importantly, click the buy and sell buttons. The quality of this technology is paramount. Is it fast and responsive, or does it lag? Is it stable, or does it crash right when the market gets volatile? Is it intuitive and user-friendly, or confusing and cluttered? This platform is your window to the markets, and a foggy, distorted, or cracked window can make navigating them almost impossible. So, we now understand a broker's role. They provide the access, the leverage, and the technology. They are the essential gatekeepers to the world of Forex. But this understanding immediately raises the most crucial question of all, the one that should keep any aspiring trader up at night. How do you know you can trust them? In a digital world, how can you be sure the platform you're sending your money to is a legitimate, well-run financial institution, and not just a slick website operated from an unregulated offshore location, ready to vanish with your funds? The answer, the bedrock of a trader's safety and peace of mind, comes down to one single powerful word: regulation. And in our next part, we will demystify the entire regulatory landscape. We'll explore the key agencies that police the financial markets, and I will show you exactly how to check a broker's credentials, how to verify their licenses, and why knowingly trading with an unregulated broker is one of the gravest, most avoidable mistakes you can ever make. Let's talk about a trader. We'll call him Mark. Mark was smart, he'd done his homework on technical analysis, he understood market fundamentals, and he'd saved up $5,000, a significant sum for him, to start his trading journey. He found a broker online with a slick website, an easy-to-use platform, and an incredible sign-up bonus. They promised tight spreads and lightning-fast execution. He felt like he'd found a hidden gem. He deposited his $5,000 and started trading. For a few weeks, things went well. His account balance grew. He saw the numbers on the screen go up and felt the thrill of success. Then, he decided to withdraw some of his profits. He put in a withdrawal request and waited. A week went by. Nothing. He emailed customer support. They replied with a generic message about processing delays. Another week. He called their support number, which went straight to an automated message. Panic started to set in. He tried to log into his account, and this time the password was invalid. He tried to reset it, but the email never came. The website, once so slick and professional, suddenly looked like a ghost town. Mark's $5,000 plus his profits were gone. Vanished. What went wrong? Mark didn't make a bad trade. He didn't misread a chart. His mistake happened before he ever placed a single order. He chose an unregulated broker. He stepped into the financial Wild West without any armor, and he paid the price. This story or versions of it plays out every single day. And it's why this part of our journey together is arguably the most important. Everything else, strategies, platforms, analysis, is meaningless if your money isn't safe. Regulation is your armor. It is the single most critical factor that separates legitimate financial institutions from digital predators. So, what does this armor actually do for you? First, and most importantly, top-tier regulators mandate something called segregated client funds. This is a non-negotiable rule. It means the broker must keep your money in a separate bank account from their own operational funds. They can't use your deposit to pay their office rent or their CEO's bonus. If that broker goes bankrupt, your money isn't considered part of their assets to be paid out to creditors. Still, your money protected and separate. Unregulated brokers? They can, and often do, lump all the money together. Your deposit, their revenue, it's all in one pot. If they go bust or just decide to disappear, your money disappears with them. Second, many top regulators provide some form of investor protection scheme. In the unlikely event a regulated broker does fail, these schemes can act as a form of insurance, compensating clients up to a certain amount. It's a safety net. An unregulated broker offers no such thing. When the money's gone, it's gone. Third is fair play and dispute resolution. Regulated brokers are held to strict standards of conduct. They can't manipulate prices or create artificial glitches that work against you. And if you have a legitimate dispute with them, say a trade was closed incorrectly causing you a loss, you have a higher power to appeal to. You can file a complaint with the regulator, a powerful body with the authority to investigate and enforce a ruling. With an unregulated broker, who do you complain to? Their own customer service department? It's like asking a fox to investigate a missing chicken. So who are these guardians? Who are the sheriffs policing this Wild West? In the world of financial regulation, there's a hierarchy. We call them tiers. Tier 1 regulators are the gold standard. These are the agencies in major, stable financial centers with the strictest rules and the most aggressive enforcement. For a United States audience, the two you must know are the CFTC, the Commodity Futures Trading Commission, and the NFA, the National Futures Association. The CFTC is the government agency, the top-level regulator. The NFA is the self-regulatory organization for the derivatives industry, which Forex falls under. A Forex broker legally operating and accepting clients in the U.S. must be registered with the CFTC and be a member of the NFA. There are no exceptions. Other Tier 1 regulators you'll frequently see with reputable global brokers include the UK's Financial Conduct Authority, or FCA, and the Australian Securities and Investments Commission, or ASIC. These are also highly respected and known for their stringent requirements. Then you have Tier 2 regulators like SISEC in Cyprus or the DFSA in Dubai. They are still strong, reputable authorities, but the absolute top-tier brokers will almost always hold at least one Tier 1 license. And then, you have the offshore jurisdictions, places like Vanuatu, St. Vincent and the Grenadines, or the Marshall Islands. Getting a license here can be as simple as paying a fee and filling out some paperwork. Enforcement is minimal to non-existent. When you see a broker only regulated in one of these locations, it should be treated as a massive red flag. It's not real armor. It's a cardboard cutout of a shield. Okay, so theory is great, but let's get practical. I'm going to walk you through, step by step, exactly how to verify a broker's regulatory claims. Let's use the US as our prime example. Every legitimate broker will display their regulatory information on their website, usually in the footer at the very bottom of the page. They'll say something like, broker name, is a member of the NFA and registered with the CFTC. They will also list an NFA ID number. Your job is not to trust this. Your job is to verify it. Here's how. First, copy that NFA ID number. Second, open your web browser and search for NFA Basic Search. BASIC stands for Background Affiliation Status Information Center. It's the NFA's public database, and it's your window into the soul of a broker. Click the link to the NFA's website. You'll see a search box. Paste the NFA ID number you copied from the broker's website into that box and hit search. The search results will show you the firm's name. Click on it. Now you are looking at the broker's official report card. The first thing to check is the name. Does the name on the NFA site exactly match the name of the broker on the website you're looking at? Scammers sometimes use the ID of a legitimate firm, hoping you won't notice the name is slightly different. Next, look at the current status. You want to see two things here. It should say registered with the CFTC and member of the NFA. If it says withdrawn or not a member, run. That broker is not authorized to operate in the US. Then, scroll down and look for a section called Regulatory Actions and Arbitrations. This is where any disciplinary history is listed. Has the NFA ever fined them or taken action against them for rule violations? Seeing an action here isn't an automatic disqualifier. Even large, reputable firms can have minor infractions over decades of business, but it's crucial information. It tells you if you're dealing with a company that has a pattern of problematic behavior. This exact same process applies to other regulators. The FCA in the UK has a Public Financial Services Register. ASIC in Australia has one too. You never ever take a broker's word for it. You always go directly to the regulator's official website, search for their name or license number, and verify their status with your own eyes. It takes 5 minutes, and it can save you from financial devastation. So what are the red flags to watch out for? The first, obviously, is a broker who isn't regulated at all, or is only regulated in one of those weak offshore jurisdictions I mentioned. The second red flag is vague language. If a broker says they are in the process of becoming regulated, or that they adhere to regulatory standards, that's a clever way of saying they are not regulated. Regulation is black and white. You either are or you are not. There is no in between. A third red flag is when the broker's website and the regulator's database don't match. A different company name, a different address. Anything that doesn't line up perfectly is a sign to close that browser tab and never look back. Finally, be wary of any broker that contacts you out of the blue, pressuring you to deposit funds with promises of huge, easy returns. Legitimate, regulated brokers don't operate like that. They are financial service providers, not telemarketers selling a miracle product. Choosing a well-regulated broker is the foundation of your entire trading house. Without it, everything you build on top, your strategies, your analysis, your hard-earned capital, can be washed away in an instant. It's the boring part of trading, I know. It's not as exciting as looking at charts or discussing market news, but it's the professional part. It's the part that separates serious market participants from gamblers. Now that we've built that solid foundation of safety and security, we can start looking at the features of the house itself. We know how to find a broker who won't steal our money. But how do we find one who will give us a fair chance to make money? The single biggest factor that will impact your profitability, trade by trade, day by day, is the cost of doing business. In the next part, we are going to pull back the curtain on how brokers actually make their money from you. We'll dissect the 3 primary costs you'll face: the spread, commissions, and swap fees, and I'll show you how to find a platform whose fee structure aligns with your trading style, not against it. So let's pull back the curtain. Every time you see a price for a currency pair, like the euro versus the US dollar, you're not just seeing one number. You're seeing 2. There's the price the broker is willing to buy at, the bid price, and the price they're willing to sell at, the ask price. The ask is always slightly higher than the bid. And that tiny gap, that little sliver of difference between the two, that's the spread. It's the broker's built-in, fundamental profit on every single transaction. Think of it like this. You're at an airport currency exchange kiosk. You want to buy euros. They'll sell them to you for, let's say, $1.10. But if you immediately tried to sell those euros back to them, they wouldn't give you $1.10. They might offer you $1.08. That 2-cent difference is their spread. They made 2 cents just for facilitating the transaction. Forex brokers do the exact same thing, but on a massive digital scale, millions of times a second. That spread is their compensation. It's their slice of the pie. In the Forex world, we measure this spread in something called pips. A pip, which stands for percentage in point, is typically the 4th decimal place in most currency pairs. So if the euro to US dollar bid price is 1.1050 and the ask price is 1.1051, the spread is 1 pip. For a standard lot of 100,000 units, that 1 pip spread would represent a cost of about $10 just to open the trade. Now that might sound small, but if you're an active trader making dozens of trades a day, those pips add up into a mountain of costs. It's a silent tax on your trading activity. This is where it gets interesting. Spreads come in 2 main flavors: fixed and variable. A broker offering a fixed spread will, for example, always charge a 2-pip spread on the euro to US dollar, regardless of what's happening in the market. This offers predictability. You always know your cost. For a beginner, this can be comforting. there are no surprises. But variable spreads are where the pros often look. These spreads fluctuate with market supply and demand. During a calm, highly liquid trading session, like when both London and New York are open, the spread on a major pair might shrink to almost nothing. We're talking fractions of a pip. It's incredibly cheap to trade. However, there's a catch. During a massive news event like an interest rate announcement, or during periods of low liquidity like the middle of the night, that variable spread can blow out. It can widen dramatically, making it very expensive to enter or exit a position. So it's a trade-off. The potential for near zero costs versus the risk of unpredictably high costs during volatility. The second major cost is the one people see more clearly: commissions. Now you might think, wait, a spread and a commission? That sounds expensive. But it's usually one or the other as the primary model. Some brokers, particularly those offering what are called ECN or raw spread accounts, give you direct access to the rock bottom, interbank market spreads. These spreads can be as low as zero. You're seeing the true market price. But since they aren't making money on the spread, they charge a small fixed commission for every trade you place. It's a different business model. It's like choosing between two stores. One store sells a t-shirt for $25 with free shipping. The other store sells the exact same t-shirt for $20, but charges a flat $5 for shipping. In the end, the cost is identical. The commission-based model is simply more transparent. It unbundles the costs. You see the true price of the asset, and you see the separate fee for the broker's service. For high-volume traders, the scalpers who are in and out of the market in minutes, this model can be far more cost-effective. They'd rather pay a tiny fixed commission on a 0 pip spread than a full 1 pip spread on every single one of their 100 daily trades. The math, over time, heavily favors the commission model for that style of trading. And this brings us to the third, and perhaps most misunderstood cost: the swap fee. This is the silent killer for anyone who holds a trade for more than a day. It's also known as the rollover fee or overnight fee. Here's how it works. When you trade Forex, you are always buying one currency and simultaneously selling another. In essence, you are borrowing the currency you sold to finance the purchase of the currency you bought. Just like any loan, there's an interest rate attached. The swap fee is simply the difference in the interest rates between the two currencies in your pair. Let's say you buy the Australian dollar versus the Japanese yen. Historically, Australia's central bank has had a higher interest rate than Japan's, which has been near zero for years. Because you own the higher interest rate currency, the Aussie dollar, and have borrowed the lower interest rate currency, the yen, the broker will actually pay you a small amount of interest for every night you hold that position open. This is called a positive swap. But now let's flip it. If you sell the Australian dollar to Japanese yen, you're now borrowing the high interest currency and holding the low interest one. In this case, you will have to pay the interest rate differential. You'll be charged a swap fee every single day. For most retail traders on most pairs, the swap is a net cost. It's a fee for the privilege of holding a leveraged position overnight. And this fee can eat away at the profits of a long-term trade if you're not paying attention. And here's a pro tip that catches so many people off guard. Watch out for Wednesday. Because the Forex market is technically closed for settlement over the weekend, brokers have to account for Saturday and Sunday's interest. To do this, they apply 3 days' worth of swap fees on a single day, which is almost always at the close of the New York session on Wednesday. If you're on the wrong side of a trade with a negative swap, holding it over that Wednesday close means you get hit with triple the daily fee. For a swing trader holding a position for weeks, that can be a significant and unexpected cost. So how do you put this all together? You have to match the fee structure to your trading personality. Are you a scalper or a day trader getting in and out fast? If so, your world revolves around the spread and commissions. You live and die by transaction costs. You should be laser-focused on finding a broker with the tightest possible ECN spreads and the lowest commissions. The swap fee is almost irrelevant to you because you never hold a trade overnight. Are you a swing trader holding positions for a few days to a few weeks? The spread is still important, but it's not the be-all and end-all. A slightly wider spread on a trade that's aiming for 200 pips of profit is less impactful. For you, the swap fee becomes a major character in your story. You need to be acutely aware of the daily cost of holding your positions and factor that triple swap Wednesday into your calculations. It could be the difference between a profitable trade and a losing one. Or are you a long-term position trader? Or someone interested in a carry trade strategy? For you, the swap is everything. You might specifically look for currency pairs with a large positive interest rate differential, where the broker literally pays you to hold the trade. The spread you pay on day one is a distant memory a year later, but that daily positive swap has been compounding in your account. The bottom line is this: there is no single cheapest broker. It's an illusion. The cheapest broker for a scalper could be ruinously expensive for a swing trader, and vice versa. Your mission before you ever deposit a single dollar is to go to a broker's website and dig past the flashy marketing. Find the legal documents, the trading conditions, or product specification page. This is where the truth lives. Look for a table that shows the typical spread for the pairs you want to trade, not just the as low as number. Find their commission structure. Find their table of swap rates. Choosing a broker with the wrong fee structure for your style is like trying to swim the English Channel while wearing a wool suit. You might be a great swimmer, but you're being weighed down with every stroke. Your costs are working directly against your strategy. Finding the right fee structure is the first, most critical step in aligning the platform's interests with your own, ensuring that your biggest partner in this journey, your broker, is helping you, not just profiting from you. But beyond the numbers on a spreadsheet, beyond the spreads and commissions, lies the digital environment where you will spend countless hours, where every single click matters. This is the platform itself, your cockpit, your command center. The question is, has it been designed for a fighter pilot or for a passenger? Because in the world of trading, you are the pilot, and the interface you use is the critical link between your brain and the market. A poorly designed platform is like flying a plane with a sticky joystick and a foggy windshield. It doesn't matter how skilled you are. You're fighting your own equipment, and that's a battle you can't afford to lose. So let's talk about user interface and user experience, or UI and UX. These aren't just buzzwords for tech startups. They are the foundation of effective trading. A great UI is clean, intuitive, and uncluttered. It presents the most critical information, your current positions, your account balance, the price charts, in a way that's immediately understandable. You shouldn't have to hunt for the buy button or struggle to find your list of open trades. Think of it like the dashboard of a high-performance car. The speedometer, the tachometer, the fuel gauge, they're all right there in your line of sight, because in a critical moment you don't have time to look for them. A confusing platform, on the other hand, is a recipe for disaster. Imagine trying to close a losing trade quickly. But the close position button is hidden in a drop-down menu, 3 clicks away. By the time you find it, the loss could be significantly larger. These are what traders call misclicks, and they are almost always a result of poor design. A good platform minimizes the potential for these costly errors. It feels less like a complex piece of software and more like an extension of your own thoughts. At the heart of any trading platform are the charting tools. This is your window into the market's soul. A basic platform might show you a simple line chart, which is like trying to navigate a city with a hand-drawn map. It gives you a general idea but none of the crucial details. A world-class platform, however, provides a suite of sophisticated charting tools that allow you to perform deep technical analysis. We're talking about candlestick charts that tell a story of each trading session's battle between buyers and sellers. We're talking about a vast library of technical indicators, tools like moving averages to help identify the direction of a trend, the relative strength index, or RSI, to gauge if a market is overbought or oversold, and MACD to measure momentum. These aren't magic crystal balls, they are data analysis tools. They help traders to form a hypothesis about where the market might be heading, based on historical price action. The ability to draw trend lines directly on the chart, to plot Fibonacci retracement levels to identify potential support and resistance, and to view the same currency pair across multiple time frames simultaneously, from a 1-minute chart to a monthly chart, is not a luxury. For many trading strategies, it is an absolute necessity. A platform that skimps on its charting capabilities is telling you that it's not built for serious traders. But what good is the best analysis in the world if you can't act on it? This brings us to a concept that separates the professional-grade platforms from the amateur ones: execution speed. When you decide to enter or exit a trade, you click a button. In that fraction of a second, your order is sent from your computer to your broker's server, and then to the interbank market where the transaction happens. We're talking about a process that should take milliseconds, but not all platforms are created equal. A slow, laggy platform can introduce a terrifying phenomenon known as slippage. Slippage is the difference between the price you expected to get when you click the button and the actual price at which your trade was executed. In a fast-moving market, perhaps right after a major economic news announcement, prices can fluctuate wildly in a single second. If your platform is slow by the time your order is processed, the price may have moved against you. A few pips of slippage might not sound like much, but on a large position, it can be the difference between a profitable trade and a losing one, right from the very start. Top-tier platforms invest heavily in their server infrastructure, co-locating their servers in the same data centers as major liquidity providers to ensure the fastest possible execution speeds and minimize the potential for slippage. They understand that in trading, every millisecond counts. Beyond just speed, the best platforms offer you a range of tools to manage your entry and exit with precision. Most beginners only know about market orders, which is essentially telling your broker, buy or sell for me right now at the best available price. But what if you only want to buy if the price drops to a specific level you've identified through your analysis? That's where a limit order comes in. You set your desired price, and the platform will only execute the trade if the market reaches that price. Gives you control. Even more critical are the tools for risk management. A stop-loss order is one of the most fundamental. It's an order you place in advance to automatically close your trade if the price moves against you by a certain amount. It's your safety net, your automatic ejection seat. It helps to define your maximum acceptable loss on a single trade, preventing a bad decision from turning into a catastrophic one. Some platforms go even further, offering trailing stops that automatically move your stop-loss up as a trade moves in your favor, locking in profits while still giving the trade room to grow. These different order types are not just features. They are the essential tools of a disciplined trader. They allow you to build your strategy directly into the platform, letting it manage your risk and execute your plan, even when you're not in front of the screen. Finally, a great platform recognizes that no two traders are alike. What works for a long-term trend follower is completely different from what a short-term scalper needs. That's why customization is so important. The ability to create and save your own chart layouts, with your preferred indicators and settings, is a massive time saver. Building personalized watch lists of the currency pairs you're monitoring, setting up custom alerts that notify you when a price reaches a certain level or an indicator crosses a key threshold. These features transform a generic piece of software into your personal trading hub. It allows you to filter out the noise and focus only on the information that is relevant to your specific strategy. Your trading platform shouldn't force you to adapt to it. It should adapt to you. It should be a malleable tool that you can shape to fit your unique perspective on the market. When you find a platform that offers this level of control, with a clear interface, powerful analytical tools, and lightning-fast execution, you've moved beyond just finding a broker. You've found a true partner. You've secured your command center. But even with the most advanced cockpit in the world, the plane is only as safe as the airport it flies out of and the regulations that govern the sky. The most beautiful, fastest platform is utterly worthless if the company behind it is operating in the shadows, outside the reach of oversight and accountability. This very concept, oversight and accountability, is the single most important, yet most overlooked aspect of choosing a platform. It's the foundation upon which everything else is built. Because when things go wrong, and in the world of finance they sometimes do, the slick user interface and the low spreads won't be the ones answering your calls. The regulator will. Let me tell you about a trader we'll call Alex. Alex was smart, did his research on trading strategies and felt ready. He found a broker online. The website was professional, the platform looked incredible, and they offered him a 100% deposit bonus and leverage that seemed almost too good to be true. He deposited $5,000. For a few weeks everything was great. His trades were winning, his account balance was growing. He felt like a genius. Then he decided to withdraw some of his profits. He put in the request. Silence. He sent an email. No reply. He tried the live chat. It was perpetually offline. Days turned into a week. He started digging. He searched for the company's regulatory status. He found a registration number for an obscure island nation he'd barely heard of. There was no real oversight, no consumer protection, no one to call. His $5,000, and all his supposed profits, had simply vanished into the digital ether. Alex's story isn't unique. It happens every single day. The lure of high leverage and big bonuses from offshore, unregulated brokers is a siren song that has crashed many aspiring traders on the rocks. This is why the first question you must ask before you even look at a platform's features is, who is watching the watchers? Who is holding this broker accountable? This brings us to the alphabet soup of global financial regulators. These aren't just random letters. They are your first line of defense. In the United States, the two big names you need to know are the CFTC and the NFA. Think of the CFTC, the Commodity Futures Trading Commission, as the federal government setting the high-level rules of the sky. They are the ones who say, all planes must have 2 engines, a certified pilot, and a black box. They create the framework for a safe market. But the NFA, the National Futures Association, is the air traffic control you deal with every day. They are the self-regulatory organization that enforces the rules on the ground. They vet the brokers, run background checks, and have a public database called BASIC, where you can look up any firm or individual to see their registration status and any disciplinary actions. A broker operating in the US without being registered with the NFA is like an airline flying a 747 without a pilot's license. You just don't get on that plane. Hop across the pond to the United Kingdom, and you'll find the FCA, the Financial Conduct Authority. The FCA is widely regarded as one of the strictest and most respected regulators in the world. They are the Scotland Yard of finance. Their approval process is rigorous, their rules are stringent, and their enforcement is swift. Seeing that a broker is authorized and regulated by the FCA is a significant badge of honor in the industry. Fly down under, and you have ASIC, the Australian Securities and Investments Commission. ASIC is another top-tier regulator, known for its robust consumer protection measures and no-nonsense approach to enforcement. They keep a very close eye on the brokers operating within their borders, ensuring a fair and transparent market for Australian traders. Then you have other major hubs like Cyprus with CISEC, the Cyprus Securities and Exchange Commission. Because Cyprus is in the European Union, a CISEC-regulated broker has historically been a passport to operate across Europe. They've significantly tightened their standards over the years and are a major player. But it highlights the need to understand the nuances of each regulator. So why does this matter to you? Why should you care if your broker is regulated by the FCA or some entity on a remote island? It boils down to a few critical protections for your capital. First, and most importantly, is the segregation of client funds. A top-tier regulator mandates that the broker must keep your money in a separate bank account from the company's own operational funds. This is not optional. This means the broker can't use your deposit to pay their office rent or their CEO's bonus. If the company goes bankrupt, your money isn't considered part of their assets to be paid out to creditors. It's ring-fenced. It's protected. It's your money held in trust. An unregulated broker has no such obligation. Your deposit goes into their bank account, and it becomes their money to do with as they please. That is a terrifying thought. Second is capital adequacy. Regulators like the FCA and ASIC require brokers to hold a significant amount of their own capital in reserve. This acts as a financial cushion. It ensures the broker can withstand major market shocks and can honor its financial obligations to its clients, including paying out withdrawals, even during turbulent times. It's the regulatory equivalent of forcing a cruise ship to prove it has enough lifeboats for every single passenger before it's allowed to leave the port. Third, in many jurisdictions like the UK and Europe, is a concept called negative balance protection. This is a rule that is an absolute game changer for retail traders. It means you cannot lose more money than you have in your account. Period. Let's say you have $1,000 in your account and you're in a trade. A sudden massive market event happens, a surprise announcement, a flash crash, and your position plummets so fast that your losses theoretically exceed your $1,000 deposit. With a broker offering negative balance protection, your account balance will simply go to zero. You won't owe the broker another cent. Without this protection, you could end up with a negative balance of hundreds or even thousands of dollars, and the broker could legally come after you for that debt. Finally, there are compensation schemes. In the unlikely event that a regulated broker does fail, some regulators have an investor compensation fund. In the UK, for example, the Financial Services Compensation Scheme, or FSCS, may protect client funds up to £85,000. It's like the FDIC for your bank account. It's a safety net of last resort that provides an incredible amount of peace of mind. An offshore broker offers no such thing. When they're gone, your money is gone. So how do you actually verify a broker's claims? It's simpler than you think, but it requires a crucial step of due diligence. Don't just take their word for it. First, go to the broker's website and scroll all the way down to the footer. This is where they are legally required to list their company name, address, and their regulation details, including a license number. If you can't find this information easily, close the browser tab and never look back. That's red flag number 1. Once you have that license number, do not click a link on their website that says, "Verify our license here." Open a new tab and search directly for the regulator's official public register. For the US, you'd search NFA Basic Search. For the UK, FCA Financial Services Register. Go to the official source. Enter the company's name or their registration number. The search results should show you the exact same company name that's on the broker's website. Be careful of clone firms, scammers who use a name that is very similar to a legitimate, regulated company to trick you. Check the details. Is the website address listed on the regulator's page the same one you're on? Does the regulator confirm that the firm is authorized to offer the services you're interested in, and that it's permitted to deal with retail clients in your country? This 5-minute check is the most valuable research you will ever do. It separates the legitimate players from the predators in the shadows. It's the difference between trading in a well-lit, secure financial center and gambling in a back alley with no rules and no exits. The features, the spreads, the platform itself, all of that comes next. But none of it matters if the foundation isn't solid, because a trading platform ultimately is a vessel for your capital. And the first job of any captain is to ensure that the ship is seaworthy before ever leaving the harbor. So how do you check the seaworthiness of a digital vessel carrying your financial hopes? It starts not with the flashy bells and whistles, but with something far more fundamental: regulation. This is the single most important, non-negotiable checkpoint. Think of it as the ship's official registration and safety inspection. An unregulated platform is a ghost ship, operating outside of any law, accountable to no one. If something goes wrong, and it often does, you have zero recourse. Your money simply vanishes into the digital ether. For traders in the United States, the regulatory landscape is incredibly specific and stringent. The two names you must know are the CFTC, the Commodity Futures Trading Commission, and the NFA, the National Futures Association. These aren't just acronyms. They are the guardians of the market's integrity. A broker that is legally allowed to operate in the U.S. must be registered with the CFTC and be a member of the NFA. There are no exceptions. If a platform is based on some remote island with a regulator you've never heard of, and they're trying to solicit you as a U.S. client, that isn't just a red flag. It's a giant flashing skull and crossbones. Here's a story that plays out in forums and social media groups every single day. A trader, let's call him Alex, gets lured in by an offshore, unregulated broker. They promise incredibly high leverage, massive bonuses for signing up, and a slick-looking app. Alex starts trading, and he's actually doing well. His account balance is growing. He sees the numbers go up, and he feels like a genius. The platform works perfectly when he's depositing money and placing trades. Then comes the day he decides to withdraw some of his profits. He clicks the withdraw button, fills out the form, and waits. A day goes by. Nothing. A week. Nothing. He contacts customer support. At first, they're polite, citing processing delays or verification issues. Then the emails start bouncing. The live chat feature is suddenly offline. The phone number is disconnected. Within a month, the website itself is gone. Alex's profits and his initial capital have completely disappeared. He wasn't the victim of a bad trade. He was the victim of a deliberate scam, enabled by a complete lack of oversight. This is why regulation matters. A regulator like the NFA provides a layer of accountability. They have rules on how brokers must handle client funds, how they must report trades, and what they can and cannot promise. And most importantly, they have a public database. You can go to the NFA's website, look for a search tool called BASIC, which stands for Background Affiliation Status Information Center, and type in the name of the broker. It will tell you in black and white if they are a registered member in good standing, and it will list any disciplinary actions taken against them. Performing this simple check is the 5-minute task that can save you from years of financial heartache. It's the equivalent of checking a ship's registration before you load your life savings onto it. But a ship's registration is only the first step. The second is security. How well is the ship itself constructed to repel pirates and protect its cargo? In the digital world, this means cybersecurity. The first line of defense is something you've seen everywhere: two-factor authentication or 2FA. On a trading platform, this isn't an optional convenience. It's an absolute necessity. It means that even if someone steals your password, they can't access your account without a second key, usually a code sent to your phone. Not enabling 2FA on a financial account is like leaving the door to the vault open with a "Please rob me" sign on it. Beyond your personal login, you need to consider the security of the platform itself. Look for things like SSL encryption. That's the little padlock icon you see in your browser's address bar. It means the connection between your computer and the platform servers is scrambled. turning your sensitive data into unreadable nonsense for anyone trying to eavesdrop. But the most critical security feature of all happens behind the scenes. It's called segregated client funds. This is a regulatory requirement in major jurisdictions like the US, and it's a concept every trader needs to understand. It means the broker must keep your money in a bank account that is completely separate from their own corporate funds. Your capital is not their capital. They can't use your money to pay for their office rent, their employee salaries, or their marketing campaigns. This is profoundly important. Why? Because if the brokerage firm fails and goes bankrupt, your money isn't part of the assets to be liquidated to pay their creditors. It remains your property. It's the difference between your cargo being in a dedicated, sealed container with your name on it, versus being dumped into the ship's general hold, mixed in with the crew's supplies. One is protected, the other is at risk. A reputable broker will be very clear and public about their use of segregated accounts. So the ship is registered and the cargo is secure. What's next? The engine. We're talking about reliability and platform stability. A trading platform can have the best security and the strongest regulation, but if it breaks down in the middle of a storm, none of that matters. The storm in the Forex market is high volatility. This is typically during a major news release, an interest rate decision from the Federal Reserve, a non-farm payrolls report, a sudden geopolitical event. During these few minutes, the market can move with breathtaking speed and ferocity. This is the ultimate stress test for a platform, and it's where poorly built platforms fail catastrophically. Imagine you're in a trade, and the market is moving violently against you. You need to get out now. You click the close button, and you get the spinning wheel. The platform has frozen. It can't handle the sheer volume of orders and data flooding its servers. Seconds feel like hours. By the time it finally responds, the price has blown past your stop loss, and your loss is many times what you had anticipated. Or worse, the platform starts giving you requotes, constantly telling you the price has moved and you need to resubmit your order, effectively trapping you in a losing position. This is not just frustrating, it can be account destroying. A high-quality platform, on the other hand, is built for these moments. It has robust, redundant servers, high-speed execution, and deep liquidity pools to ensure that your orders get filled at the best available price, even in the most chaotic conditions. They invest millions in their infrastructure precisely so that the engine doesn't stall when you need it most. So how can you test this without risking real money? This is where a demo account becomes more than just a practice tool. Use the demo account during major news events. Try to place and close trades. See how the platform responds. Does it lag? Does it freeze? Is the price feed stable? A demo account on a reputable platform should mirror the performance of a live account. It's your sea trial. You take the ship out in rough weather to see how it handles before you commit to a long-haul voyage. Once you've confirmed the vessel is properly registered, its security is ironclad, and its engine is reliable under pressure, only then can you confidently step into the cockpit. Only then can you start to concern yourself with the advanced navigation systems, the charting tools, and the analytical instruments. Because it's in that cockpit where a trader uses their skill to navigate the markets. It's where raw data is transformed into informed decisions. And it's that suite of powerful tools, the charts, the indicators, the very heart of technical analysis, that we will dissect next. At the center of this digital cockpit is your primary window into the market's soul. The price chart. This isn't just a squiggly line. It's a living, breathing chronicle of human emotion. A battlefield where every tick represents a skirmish between buyers and sellers. To the untrained eye, it's chaos. But to the analyst, it's a story waiting to be read. The most basic way to read this story is with a line chart. It's clean, simple, and connects the closing prices over a set period. It gives you the 30,000-foot view, the general direction of the trend, like reading the headline of a newspaper. But for a trader, the headline is never enough. You need the details, the nuance, the story behind the story. That's where the bar chart comes in. Each bar gives you 4 key pieces of information: the open, the high, the low, and the close for that time period, often called an OHLC chart. You see not just where the price ended, but the entire range of the battle that took place. But for many, the true language of the market is spoken through Japanese candlesticks. They convey the same 4 data points as a bar chart, but they do it with a visual elegance that tells a story at a glance. Each candle has a body and wicks, or shadows. The body represents the distance between the open and close price. If the close is higher than the open, the body is typically colored green or white, a story of bullish victory. If the close is lower than the open, it's red or black, a story of bearish dominance. The wicks show the highest and lowest prices reached during that period, the furthest territory each side managed to explore before being pushed back. A long upper wick on a red candle tells a tale of buyers who charged forward with optimism, only to be decisively beaten back by sellers by the session's end. A long lower wick on a green candle shows sellers tried to drag the price down, but a powerful wave of buyers swept in and lifted it to a strong close. Learning to read these individual candles and the patterns they form is like learning the vocabulary of the market itself. But reading the raw text of the charts is only the first step. To truly understand the subtext, traders turn to technical indicators. These are mathematical calculations layered on top of the chart, acting like specialized lenses to help you see what isn't immediately obvious. They don't predict the future. They provide a framework for analyzing the past and understanding the present market conditions. The most fundamental of these are the trend-following indicators, and their king is the moving average. A moving average smooths out the chaotic day-to-day price action to reveal the underlying trend. A simple moving average, or SMA, does this by taking the average closing price over a specific number of periods, say 50 days. It gives equal weight to every day in that period. Its cousin, the exponential moving average, or EMA, is a bit more sophisticated. It also calculates an average, but it gives more weight to the most recent prices, making it react more quickly to new information. Analysts often use two moving averages together, a faster short-term one and a slower long-term one. When the short-term average crosses above the long-term one, some analysts view this as a potentially bullish signal, an event known as a golden cross. Conversely, when it crosses below, it's dubbed a death cross, which may be interpreted as a bearish signal. These are not crystal balls, but rather a way to mathematically define and visualize a shift in the market's momentum. Speaking of momentum, that brings us to our next class of indicators, oscillators. While moving averages help you gauge the direction of the trend, oscillators help you measure its velocity and strength. The most famous is the Relative Strength Index, or RSI. The RSI doesn't measure price, but rather the speed and magnitude of price changes. It moves on a scale from 0 to 100. A common interpretation is that a reading above 70 suggests an asset might be overbought, and a reading below 30 suggests it might be oversold. Now, this is a critical point of caution. Overbought doesn't automatically mean sell, and oversold doesn't mean buy. In a very strong uptrend, an asset's RSI can stay above 70 for a long time as it continues to climb higher. These are not standalone signals, but rather temperature gauges for the market's enthusiasm. They tell you if the engine is running hot or cold, which is valuable context for any decision. Another powerful tool for gauging market conditions is Bollinger Bands. This indicator is a masterclass in visualizing volatility. It consists of three lines, a simple moving average in the middle, and an upper and lower band on either side. These outer bands are typically set at 2 standard deviations away from the middle band. Think of it like a river. When the market is calm and quiet, the price action is gentle, and the bands, the riverbanks, are narrow and close together. When volatility explodes, the price starts swinging wildly, and the bands expand dramatically to contain the movement. Analysts use this in several ways. A price touching the upper band isn't necessarily a sell signal, but it does show that statistically, the price is high relative to its recent average. Some traders watch for a squeeze, where the bands get extremely tight, often seeing it as a sign of a market coiling up for a big move in either direction. Beyond these automated, calculated indicators, the platform provides a digital drafting table with a suite of drawing tools. This is where analysis becomes an art form. The most basic tool is the trend line. By simply connecting a series of higher lows in an uptrend, or lower highs in a downtrend, you can create a visual boundary for the price action. These lines often act as dynamic levels of support and resistance. Support is a price level where buying pressure has historically been strong enough to overcome selling pressure, causing the price to bounce. Resistance is the opposite, a price ceiling where sellers tend to emerge and halt in advance. For more advanced analysis, many turn to Fibonacci retracement. Named after a 13th century mathematician, this tool is based on a sequence of numbers where key ratios appear frequently in nature, from seashells to galaxies. In trading, analysts draw these levels between a major high and low to identify potential areas where a price pullback might stall and reverse. The key levels, 23.6%, 38.2%, 50%, and 61.8%, can become invisible zones of support or resistance. It's a fascinating application of a natural mathematical principle to the chaos of financial markets. Finally, all these tools come together in the identification of chart patterns. These are recurring shapes in the price action that are believed to have some predictive value based on historical performance. There's the classic head and shoulders, a reversal pattern that looks like a silhouette of a person, often signaling a potential top in the market. There are double tops and double bottoms, which look like the letters M and W respectively, suggesting the market tried to break a key level twice and failed. Then you have consolidation patterns like triangles and flags, which often represent a brief pause in a trend before it continues on its original path. These patterns are not infallible. They are probabilistic studies in market psychology. They represent the collective indecision, exhaustion, or renewed conviction of millions of market participants, drawn out on a chart. This entire suite of tools transforms a trading platform from a simple order entry system into a sophisticated analysis workshop. The charts are your material, the indicators are your precision measurement instruments, and the drawing tools are your design implements. But having the best tools in the world doesn't build the house. You still have to execute the plan. You have to know how to place your orders, how to manage your risk, and how to execute your strategy with discipline. And it is that crucial step, translating analysis into action, that we will explore next. So you've done your homework. The charts are analyzed, the economic calendar is checked, and you have your trading thesis, your reason for believing a currency pair is about to move up or down. You've built the architectural blueprint for a potentially successful trade. But a blueprint has never sheltered anyone from a storm. Now you have to pick up the tools and build the house. This is the moment where theory meets reality, where all your analysis crystallizes into a single action: the click of a button. When you open the order window on your trading platform, it can feel like sitting in the cockpit of a fighter jet for the first time. You see buttons, numbers, and drop-down menus for things like market execution, pending order, stop loss, take profit, and volume. It's easy to feel overwhelmed, but understanding these controls is the absolute foundation of turning your analysis into action. Let's break down the most critical tool first: how you enter the market. Your most basic entry method is the market order. Think of this as the "Get Me In Right Now" button. When you place a market order, you are telling your broker you want to buy or sell a currency pair at the best available price at that exact moment. It's the fastest way to enter a trade. If you see a setup happening in real time and believe you need to act immediately, a market order is your tool. But this speed comes with a small yet significant trade-off called slippage. In a fast-moving market, the price you click on and the price your order actually gets filled at can be slightly different. It might be a fraction of a pip, but in the world of trading, those fractions matter. It's like seeing an item online for $99.99, but by the time you get to checkout, the price has updated to $100.50. A market order prioritizes speed over price precision. But what if your strategy is based on precision? What if your analysis says, the euro-dollar is likely to bounce if it drops to this specific support level but not before? You don't want to enter now. You want to enter at your price. This is where pending orders come in, and they are the tools of a strategic, patient trader. The first type is the limit order. A limit order says, I want to buy or sell, but only if the price reaches a level that is more favorable than the current price. Let's break that down. A buy limit is placed below the current market price. You're essentially setting a net saying, I believe the price will dip to this level and then reverse upwards. Wake me up when it gets there and enter my buy trade. Conversely, a sell limit is placed above the current market price. You're saying, I think the price will rally up to this resistance level and then fall. Enter my sell trade if and when that happens. Limit orders are for traders who anticipate reversals and want to get in at a better price. It's the art of letting the market come to you. The other type of pending order is the stop order, and it's used for a completely different strategy. A stop order says, I want to buy or sell, but only if the price breaks through a certain level, showing momentum in that direction. A buy stop is placed above the current market price. You're saying, if the price can break through the ceiling of resistance, I believe it's going to keep running higher, and I want to jump on that train as it leaves the station. A sell stop is placed below the current market price. You're telling your platform, if the price breaks down through this floor of support, I think it's going to crash further, and I want to be in a sell position to ride it down. Stop orders are the tools for breakout traders, those who want to capitalize on momentum once it's confirmed. So you have your entry orders, market, limit, and stop. You now know how to get into a trade. But here's a truth that separates consistently profitable traders from the 90% who fail. Getting into a trade is the least important part of the equation. The two most important decisions you will ever make happen right after you decide to enter. They are your exit plans. They are your stop loss and your take profit. Let's talk about the stop loss first because it is, without a shadow of a doubt, the single most important order you will ever place. A stop loss is a preset order that automatically closes your trade at a specific price point if the market moves against you. It is your safety net. It is your fire escape. It is the circuit breaker that protects your entire account from a single bad decision. Trading without a stop loss is like driving a race car without a seatbelt or brakes. It might feel exhilarating for a moment, but the end result is inevitable and catastrophic. When you set a stop loss, you are quantifying your risk. You are looking at your trade setup and saying, I am willing to risk this specific amount of money, and no more, to see if my analysis is correct. It is the ultimate act of discipline and humility. It's an admission that you can be wrong, that the market can do anything at any time, and that your number one job is not to make money, but to protect the capital you already have. Your platform's stop-loss function is the tool that enforces this discipline for you, removing the emotion, hope, and fear that would otherwise cause you to hold on to a losing trade, praying it will turn around as it drains your account. On the other side of the coin is the take-profit order. If the stop-loss is your shield, the take-profit is your spear. It's a preset order that automatically closes your trade when it reaches a certain level of profit. Why is this so important? Because of an emotion just as dangerous as fear, greed. How many times has a trader watched a position go deep into profit, only to think, just a little more? They get greedy, the market reverses, and that beautiful winning trade turns into a break-even trade, or even worse, a loser. A take-profit order is your pre-committed decision, made when you are calm and analytical, about where your trade has a high probability of reaching. It's you, the strategist, telling you, the emotional trader in the heat of the moment, this is the plan. We've hit our objective. Mission accomplished. Take the money and wait for the next opportunity. It locks in your gains and prevents you from giving back hard-won profits to the market. These two orders, the stop loss and the take profit, are the bookends of professional trading. Before you even click buy or sell, you should know exactly where both of these orders will be placed. This defines your risk-to-reward ratio. For instance, if you set your stop loss 50 pips away from your entry, and your take profit 100 pips away, you have a 1 to 2 risk-to-reward ratio. You are risking $1 for the potential to make 2. Having a positive risk-to-reward ratio, enforced by these orders, is a cornerstone of many long-term trading strategies. Some platforms even offer more advanced versions, like a trailing stop. A trailing stop is a dynamic stop-loss that automatically moves up as the price moves in your favor. For example, you can set it to trail the price by 50 pips. If your trade goes 100 pips into profit, your stop-loss, which was once at a loss, is now automatically moved up to lock in 50 pips of profit. It's a powerful tool that allows you to let your winners run while still protecting your downside, turning a risk management tool into a profit-securing one. Ultimately, all these order types, market, limit, stop loss, take profit, are more than just functions on a platform. They are the mechanical instruments of a disciplined mind. They are the systems you put in place to protect yourself from your own worst instincts. The impulsive urge to jump into a trade, the fearful hesitation to exit a loser, the greedy desire to squeeze every last pip out of a winner. These are the psychological demons that haunt every trader. Your platform's order functionality is your weapon against them. Learning to use these tools with precision and consistency is how you move from being a gambler who bets on price movements to a strategist who manages risk and executes a well-defined plan. And it's the structure of that plan, the very rulebook you create for yourself, that forms the final pillar of a trader's foundation. This rulebook, your personal trading plan, is the single most critical document you will ever create in your trading journey. It's the constitution for your entire trading business. Think about it. A pilot never takes off without a flight plan and a pre-flight checklist. A surgeon never enters the operating room without a detailed surgical protocol. They have a plan for what to do when things go right, and more importantly, a plan for what to do when things go wrong. Why should risking your hard-earned capital be any different? Your trading plan is your flight plan. It's your surgical protocol. It is the objective, unemotional set of rules that guides every decision you make, shielding you from the two most destructive forces in any market: fear and greed. Without a plan, you are trading on impulse. You see a big green candle and FOMO, the fear of missing out, kicks in. You jump in chasing the price with no idea where you'll get out or how much you're willing to lose. Then the market turns. That green candle becomes a terrifying red one. Panic sets in. You sell at a massive loss, only to watch the market reverse again and head back in your original direction. This emotional roller coaster is the #1 reason why many aspiring traders fail. They become a pinball, bounced around by market noise and their own gut reactions. A trading plan is the machine that stops the pinball game. It forces you to define your actions before the emotional pressure is on. It's a contract you make with yourself to be disciplined, systematic, and professional. So what does this critical document actually contain? It's not some vague mission statement. It's a precise, detailed blueprint for your trading activity. And it's built on several core components. First, your personal trading psychology and goals. You have to start by asking yourself, why am I doing this? What do I realistically want to achieve? Is this to generate a small amount of supplemental income? Is it for long-term capital appreciation? Are you aiming to eventually trade full-time? Your answers will dictate your risk tolerance and the style of trading you adopt. You also need to be brutally honest about your strengths and weaknesses. Are you patient enough for long-term swing trading? Or do you prefer the fast-paced action of day trading? This self-assessment is the foundation upon which all other rules are built. Second, you must define your sandbox. Which markets will you play in? It's a common mistake for new traders to jump from currency pair to currency pair, looking for action. A professional focuses. They might decide, I will only trade the major pairs, like the euro/US dollar and the British pound/US dollar, because they have high liquidity and low spreads. You also need to define your time frame. Will you be making decisions based on daily charts, 4-hour charts, or 15-minute charts? A trader who analyzes a daily chart has a completely different perspective and set of rules than a scalper looking at a 1-minute chart. Pick your markets, pick your time frames, and become an expert in that specific environment. Third, and this is the real meat of the plan, your exact entry criteria. This cannot be ambiguous. It must be a concrete, testable set of conditions. A vague rule like buy when the price looks like it's going up is useless. A specific rule is, I will enter a long position on the US dollar/Japanese yen only when the price closes above the 20-period exponential moving average on the 1-hour chart. The MACD indicator has a bullish crossover below the zero line, and the trade is initiated between 8 a.m. and 11 a.m. Eastern Time. See the difference? It's a checklist. If condition A, B, and C are met, I enter. If even one is missing, I do not take the trade. Period. There is no room for interpretation or gut feeling. Fourth, and arguably more important than your entry, are your exit criteria. Every single trade must have a predefined exit plan for both a loss and a win. This starts with the stop-loss order. Before you even click the buy button, you must know the exact price point at which the trade idea is proven wrong. This is your line in the sand. This is how you protect your capital. Your plan must state unequivocally where your stop-loss will be placed on every trade. Equally important is your take-profit target. How will you exit a winning trade? Will you have a fixed price target based on a key resistance level? Will you use a trailing stop to let your profits run? Will you exit when an opposing signal appears? Not having a plan for taking profits often leads to greed, where a trader holds on to a winning position for too long, only to watch it turn into a loser. Fifth is the engine of survival, your risk and money management rules. This is where you define your position size. The most critical rule in any trading plan is how much of your account you will risk on a single trade. Many professional traders adhere to the 1% rule, meaning they will never risk more than 1% of their total trading capital on any given trade. If you have a $10,000 account, you would not risk more than $100. This might sound small, but it's the key to longevity. It means you could be wrong 10 times in a row and still only have lost 10% of your account. It allows you to withstand the inevitable losing streaks that every single trader on Earth experiences, giving your strategy enough time to play out over the long run. Finally, your plan must include a protocol for record keeping. You need to keep a detailed trading journal. For every trade, win, lose, or break even, you should log the date, the currency pair, the entry price, the exit price, the reason for taking the trade, and the final profit or loss. But you should also log your emotional state. Were you feeling confident, anxious, greedy? After 100 trades, you will have a powerful database of your own performance. You can see which setups work best, what time of day you're most profitable, and which emotional mistakes you keep making. This journal is the feedback loop that allows you to refine your trading plan over time, cutting out what doesn't work and doubling down on what does. This plan isn't something you write once and then file away. It's a living document. You should review it every weekend, comparing your week's trading activity against the rules you set for yourself. Did you follow the plan? If not, why? The goal is flawless execution. But here's the crucial distinction. You review and adapt your plan when the markets are closed, based on data and performance. You never change the rules in the middle of a live trade, when your money is on the line and emotions are running high. A general doesn't rewrite the entire strategic doctrine in the heat of battle. They execute the plan and analyze the outcome later. Your trading plan gives you that military-grade discipline. It's the framework that allows you to operate like a casino, not a gambler. The casino doesn't know if the next spin of the roulette will be red or black, but it knows that over thousands of spins, its statistical edge will prevail. Your trading plan is your edge. By writing it down and following it with unshakable discipline, you are building your own house advantage. With your platform chosen, your analysis honed, and your trading plan written in ink, there's only one variable left to master. The one staring back at you in the mirror. Because the ultimate battle in the market isn't against the charts or the algorithms. It's against yourself. The market, in its purest form, is a psychological arena. Every tick up, every tick down, is a reflection of the collective fear and greed of millions of people. And when you step into that arena, it holds up a mirror. It doesn't care about your ego, your hopes, or your needs. It will ruthlessly expose every single one of your mental weaknesses. The greatest challenge isn't finding the perfect indicator or the holy grail strategy. It's conquering the emotional roller coaster that derails even the most brilliant technical analysts. Let's start with the most seductive of these inner demons. Greed. Greed is the whisper in your ear after a winning trade that says, let it run a little longer. You could double your money. It's the impulse that makes you increase your lot size far beyond your risk tolerance because you feel invincible. Greed transforms a well-thought-out trading plan into a lottery ticket. It convinces you to chase a skyrocketing currency pair, jumping in at the absolute peak, right before it reverses. A professional trader understands that the goal is not to catch every last pip of a move. The goal is consistent, disciplined execution. They take their planned profit, close the trade, and move on to the next opportunity, knowing that pigs get fat but hogs get slaughtered. Greed is the hog, always wanting more, and almost always losing everything in the process. It's the difference between building a business and pulling the lever on a slot machine. If greed is the siren's call, then its twin is fear. Fear is the paralysis that grips you when your perfect setup appears on the chart. Your analysis is done, every rule in your plan is met, but you hesitate. Your finger hovers over the button and a voice screams, what if it's a fake out? What if you lose? This is called analysis paralysis, and it's born from a fear of being wrong. But fear has another, more destructive side. It's the panic that sets in during a normal, healthy pullback in a winning trade. The chart moves against you by a few pips, and suddenly your conviction evaporates. You close the trade for a small loss or a tiny profit, only to watch in agony as it turns around and hits your original profit target. Fear magnifies the importance of any single trade, making you forget that your success is determined by the outcome of the next 100 trades, not just this one. It makes you focus on avoiding loss instead of executing your plan. Then there's the most dangerous emotion of all, the one that blows up more accounts than any other: hope. In life, hope is a virtue. In trading, it can be a catastrophic liability. Hope is what keeps you in a losing trade long after your stop loss should have been triggered. You watch the position go deeper and deeper into the red, thinking, it has to turn around. It's oversold. It'll come back. You're no longer trading based on analysis. You're praying. You're wishing. You're treating the market like a forgiving entity, when in reality, it's an indifferent machine of probability. A stop loss is a logical decision you made when you were calm and rational, before you even entered the trade. It is your business's risk management plan in action. Ignoring it in a moment of hope is like a pilot ignoring a stall warning, because they hope the plane will magically start flying upwards again. It's a recipe for disaster. And finally, we have regret, which often manifests as FOMO, the fear of missing out. You see a massive move on a pair you weren't watching. You feel that pang of regret, that feeling of being left behind. So you jump into the next trade that looks even remotely similar with no proper setup, just to soothe the sting of the opportunity you missed. This is called revenge trading, and it's a vicious cycle. You make an emotional, unplanned trade to make up for a missed opportunity, That trade inevitably loses, and now you feel an even stronger urge to make it all back on the next trade, with even more risk. FOMO is a poison that clouds your judgment and forces you to break every rule in your book. The market will always be there tomorrow. There will be thousands of other opportunities. A professional mindset understands that missing a trade is not a loss. Taking a bad trade is. So, how do you combat these four horsemen of the trading apocalypse? It's not about eradicating emotion. You're human. It's about building a system of discipline and habits that insulates your decision-making from your emotions. First and foremost is unwavering, non-negotiable discipline. Your trading plan is your constitution. It is the law. You must follow it to the letter on every single trade. No exceptions. If your plan says you risk 1% per trade, you risk 1%. Not 1.5 because you have a good feeling. If your plan says you don't trade during major news events, you close the charts and walk away. Discipline is the bridge between your goals and your accomplishment. It's built in the small moments by making the right choice again and again and again until it becomes automatic. The single most powerful tool for building this discipline is a detailed trading journal. This is not just a log of your wins and losses. That's a spreadsheet. A journal records your why. Why did you enter this trade? What was your emotional state? Were you calm and objective? Or were you feeling greedy after a big win? Why did you exit? Did you follow your plan? Or did you panic? By documenting your thoughts and feelings, you start to see patterns in your own behavior. You might discover that you consistently lose money on Friday afternoons because you're tired and impatient. You might find that your biggest losses always come after your biggest wins because you get overconfident. Your journal is your personal coach. It's the brutally honest feedback that forces you to confront the mistakes your ego wants to forget. This all leads to the ultimate mental shift. Treating your trading like a business. Think about it. A business owner doesn't get emotional if one customer doesn't buy something. They don't shut down the store because they had a slow Tuesday. They have a business plan. They track their inventory, their expenses, which in trading are your losses, and their revenue. They focus on quarterly and annual performance, not on minute-to-minute fluctuations. Your trading should be the same. Each loss is not a personal failure. It's a business expense, a calculated risk. Your job as the CEO of your trading business is to manage those risks and ensure that, over a large sample size of trades, your system has a positive expectancy. When you view it this way, a single losing trade loses its emotional power. It's just a data point on the path to long-term profitability. Over these 10 parts, we've journeyed from the very basics of what Forex is, to the intricacies of platforms and brokers, through the depths of technical and fundamental analysis, and the architecture of a trading plan. But all of that knowledge is just potential energy. The catalyst that turns it into success is you. It's the mindset you cultivate. The journey to becoming a consistently successful trader is not a sprint. It's a marathon of continuous learning and self-improvement. The market will change. New strategies will emerge. The only constant is the human element. The real prize isn't just the potential financial outcome. It's the person you have to become to achieve it. You learn to be disciplined when it's easy to be impulsive. You learn to be patient when your mind is screaming for action. You learn to be humble in the face of uncertainty and resilient in the face of adversity. The charts, the platforms, the indicators, they are just the tools. The ultimate asset, the one you're truly building, is yourself. The market is the forge, and through its fire, you have the opportunity to craft a stronger, more disciplined, and more objective version of you. And that is a journey worth taking.